Hello, my awesome accounting students. Welcome back to the second half of Chapter 21.
Good morning. Today we're going to talk about a few leftover problems in Chapter 21. Chapter 21 has two major topics: the topic of standard budgets, the ability to flex a budget forward, and also variances is the main topic. Variances occur when we have something wrong with our initial budget. It could be that we bought or used more materials, for example, than we had hoped to. It could be that prices have gone up or down. In our case, in our world right now, it seems like prices are going up. So that could be the problem. It could also be a combination of more than one or two things. So the variances is designed to determine, it's part of the controlling feature actually of management, because if we are encountering situations where they're unexpected, we need to find out what happened, why it happened, and then go talk to the person responsible for that area, because we don't want to repeat the same mistakes if we can avoid it. So that's what we're talking about today. So let me share the screen. Today will probably be a short session, I'm thinking, because we don't have a whole lot to cover. Okay, here's our agenda for today. The video covered the variances in some pretty good detail, I think. If you've watched it, you notice that I showed you an alternative way to do the variances, which I personally believe is easier than the way the author does them. Of course, as always, my goal is to show you the simplest, easiest way that I know how. You guys are always available to make the choice in how you want to do it. So we're going to take a look. I think it's actually two problems today. We'll look at a wrap-up problem on 21-4B, I think it is, where we'll calculate variances. And then we'll go back and do one more practice problem on a flexible budget to make sure that you don't have any struggles with that. We'll spend the rest of our time taking a look at the test review sheet, and that's where we're headed. Any questions so far?
Our first exercise today will be a straightforward direct materials and direct labor variance calculation. Remember that I'm showing you an alternative way to compute these. However, I will also show you the author's solution manual so that you have a way to check your work no matter which of the different ways you decide to proceed. So this one says Lucia Company has set the following standard costs. So I would identify these as standards per unit for materials and labor. And then during May, the company incurred the actual costs. So I would identify these in my notes as actual costs. And it's imperative to know how many units they actually produced, because we need to flex forward our standards based on the units actually produced. In this case, they produced 9,000 units. So let's start with the quantity variance. And again, the acronym that I'm encouraging you to remember is SASA. For the quantity variance, it's SAS, which means the standard minus the actual quantity. So whatever variance you're looking at is inside the parentheses. This is the quantity times the standard price. And again, this needs to be based on the 9,000 units that were produced. So 9,000 units at 15 pounds per unit would give us the standard pounds allowed to create these units. In this case, I got 135,000. I don't think we need decimal places on this problem, so let me get rid of the decimals to make the presentation a little bit easier to read. The actual pounds is 138,000 pounds. Okay, I would encourage you to stop right there. Here's how many pounds we were allowed to use, and here's how many pounds we did use. You can see that we are 3,000 pounds above the allowance. that is deemed an unfavorable variance. Anytime you use more than you were allowed to spend, that costs the company money. How much money is it going to cost? Well, to finish it off, we need to multiply by the standard price per pound. In this case, that was $4. So 3,000 pounds times $4, doesn't matter what order you do this in, I'll put it here, times $4 per pound would give us a variance of $12,000, and that would be unfavorable. Let's move over to the price side. This gives us the effect of what the price change costs us in terms of our production. So here's the formula, and this is where people make the mistake. Say means take the standard minus actual price. That's not the part where they make a mistake. It's the next part, times the actual quantity. Okay, well, the standard price was $4 a pound, so $4 per pound. The actual price was $3.75 per pound. Let me get back in here and move something out of my way. So again, I would stop right there. We have a 25 cents per pound, and I do need decimal places on that. We have a 25 cent per pound variance, and that would be favorable because we were allowed to spend $4 per pound. We only spent $3.75 per pound. That is a positive outcome because we spent less than we were allowed to spend. To finalize this, we're going to multiply by the actual quantity. The actual quantity in this case was, 138,000 pounds. So when you multiply that out, 25 cents a pound times 138,000 pounds, you'll get 34,500. That was favorable. Put my F there for favorable. Although your book has not stressed this, I think it's something important that we should be doing. When you calculate the total variance, for some reason the author seemed to have forgotten that this variance is very useful. The total direct materials variance would be calculated by taking the net or the difference between these two because they have opposite signs. And so when I do that, 34,500 minus 12,000 gives me a variance. Let me make that a little bit bigger so you can see it, of 22,500. And because it's favorable, we'll take the sign of the higher one, which makes it favorable in this case. Okay, pause the video for a second, and we'll take a look at the direct labor variance next. The formula is exactly the same as it was for direct materials. However, when we speak about labor, it's not quantity as much as it is the time. So the wording might be a little bit different, but the formula itself is the same. The time variance, what your book tends to call the efficiency variance, is the acronym SAS, which means standard minus actual time. Again, whatever variance you're talking about goes inside the parentheses, times the standard rate. And it measures whether we were efficient in our use of time. A reminder that it's always based on the actual output. So in this case, they made 9,000 units, and the direct labor standard was 3 hours a unit. Most of you can probably do that in your head. 9,000 times 3 would be we were allowed to spend 27,000 hours. What we actually did spend is 31,000. and I'll put DLH for direct labor hours over here. Okay, at this point, I would stop and I would tell myself that because I spent 4,000 more hours than I was allowed to spend, I have an unfavorable variance. So I tend to identify whether it's favorable or unfavorable just as soon as I understand which way it's going. And I know that whenever I spend more time than what I was allotted to spend, that costs the company money. How much should that cost the company? To turn that into dollars, we'll multiply by the standard rate. The standard labor rate was $15 per direct labor hour. And when we do the math, 4,000 times $15 per hour, we get 60,000 unfavorable variance. So we were inefficient in the use of our time, and that cost the company $60,000. Someone needs to be talking to that production supervisor to see why we were not as efficient as we could have been. Moving over to the direct labor rate variance, SAA is the acronym. We want to take the standard minus the actual rate and then multiply that by the actual time. Again, whatever variance we're talking about goes inside the parentheses and the other side goes outside the parentheses. In this case, we're taking a look at the rate per hour that they pay their employees. The standard says we were allowed to spend $15 per hour, but we actually spent $15.10 per hour. Okay, stop. There is a differential of a dime or 10 cents. And so let me put some decimals on that. We recognize that as being unfavorable. The reason that it's unfavorable is because we spent 10 cents more per hour on our labor than what our standard allowed. To turn that into dollars in terms of what did that cost the company, remember what that last A stands for: actual time. The actual time, based on the information your author provided, is 31,000 direct labor hours. And so when we calculate that out, 10 cents per hour times 31,000 direct labor hours gives us a $3,100 unfavorable rate variance. I would encourage you to get used to computing a total direct labor variance. Even though your author didn't stress it, I think it's incredibly important that you do that. In this case, since the signs are the same, we would just add them up. And when I add up these orange lines, we would get a total direct labor variance of 63,100 unfavorable. Before we leave this problem, I told you that I would also show you the author's suggested solution. So take a look at what you see on the screen. You'll notice that each variant result was the same. So it doesn't matter which method you use as long as you have a good understanding of what it is that you're calculating. We'll move on to the next exercise, which is extremely similar, just with different data. I'll go ahead and show you the solution after you try and work it out. In this next very similar exercise, we'll be computing the same variances. There will be 3 direct material variances and 3 direct labor variance. The formulas are shown at the top. Once again, I'm showing you the alternative solution because I believe in my heart of hearts that this is much easier than the way the author described it. When we do the legwork, we find out that the company was inefficient in their use of direct materials to the tune of $6,000. That was offset by a direct materials price variance in that we saved 5 cents a pound on the materials that we bought. That 5 cents a pound savings resulted in a $4,600 favorable variance. Because the two signs are different, we netted the two and took the sign of the larger one. In this case, the total direct material variance was $1,400. Moving down, we also did the direct labor rate variance, well, time and rate. Time measures how efficient we were in the use of our human capital or our human resources, and the rate variance measures whether we achieved the labor rate that was used in our budget. On this exercise, the time or efficiency variance was unfavorable, which means that we were inefficient in our use of our human talent to the tune of $9,600. In other words, the products that we made took us 800 hours more than we anticipated. On the rate variance, we found out that we spent 5 more cents or a nickel more than we were allowed to spend. And when you multiply that out, that came up with a 940 unfavorable variance. Because the two variances share the same sign, meaning they were both unfavorable, we would simply add them together and, of course, carry over the U for unfavorable. So if those variances are deemed significant, the production supervisor would be the one contacted for the time variance to find out why we were inefficient in the use of our human resources. The rate variance, we would need to find out what was behind that. Is it something temporary? Did we maybe need some more expensive workers to fill in for those that were sick? We would go ask probing questions if that were deemed significant. As promised, here is the solutions manual with the author's version of the formulas worked out. Again, notice that all of our answers are the same. It's just a matter of how you choose to work out the problems. The next exercise is just more of the same, more practice with information given to you in a little bit different format. Read the problem carefully, and I will put up the solution since we've worked through several of these that are very similar. I'll also be showing you the author's solution. So pause the video, work on the problem yourselves, and let's check the answer out. On the screen, you'll see a suggested solution, once again using an alternative set of formulas that I believe are easier to understand. The direct materials variance is split up into quantity and price, and likewise, the same concept on direct labor is set up as the time and the rate variance. As far as the direct materials go, there was an unfavorable quantity variance of $4,000. There was an unfavorable price variance of $800. When combined, that meant the total direct materials variance was $4,800. On the direct labor side, they were inefficient in their use of human resources, resulting in an unfavorable variance of $32,700. Offsetting that on the rate side was a savings of over $1 per hour, resulting in a favorable variance of $16,635. Those two had separate signs, so we net them and take the higher of the two signs. The total direct labor variance, as shown, was $16,065. I'll follow this answer up with the suggested solution based on the author's formulas. On the screen is the author's presentation of the solution. Once again, all the results are the same results that we got using the alternative formulas. And once again, you're free to choose whatever method works best for you. Freeze the video and compare these answers to the ones that you calculated. And let me know if you have any questions. The last problem that we'll work on together asks you to prepare and analyze a flexible budget performance report. We actually worked on a similar problem the last time we got together. On problem 21-1B, we completed a flexible budget for various levels of activity. This problem wants you to use the information from that problem and compare it to the actual results for the 24,000 units of sales. If we scroll down, we'll see that is the requirement. Prepare a flexible budget performance report for the year. So what you'll want to do on this one is go back to the previous day's worth of exercises, carry over the activity or the flexed forward budget for the 24,000 units that the author described. Place these actual amounts given below next to your budgeted amounts, and then create or compute the variances and denote whether they are favorable or unfavorable. Give that a shot, and I'll be back with the summarized solutions in a moment. It's difficult to fit this all on the screen. On the left-hand side, this should look familiar to you. This is the per unit calculations that we did in the previous problem. And over here in the Q column, you'll see the budget that we flexed forward to 24,000 units. This is the top half of the budget through the contribution margin. And then let me show you the bottom half of the budget through net income. The difference on this problem is that they wanted a performance report. So they wanted you to carry the information forward from the highlighted column, from column Q here, and they wanted you to compare that to the actual results shown in column R here. And from that, you can calculate the difference and notate it as either favorable or unfavorable. Pause the video, check out your answer, and make sure that there's no questions. Here's the top half through the contribution margin, and here is the lower half through net income. Here's a look backwards at some of the things we covered in this chapter. We talked about what standards are. We learned that a standard is something that we can use to assess how well we're doing. Standard costs are used in a flexible budgeting system to help us understand the reasons for the variances. We learned how to set standard cost. We learned about cost variances. We said that a variance is just the difference between actual and standard cost. And we talked about when variances would be deemed favorable and unfavorable. We flexed forward budgets to actual levels of production so that we could compute various cost analyses. We took a look at a total of 3 direct material variances. We took a look at the materials quantity, the direct materials price, and the 2 of them combined together. And we talked about what you would do with those things and who you would go speak to if an actual cost was different from the budgeted costs. We then talked about labor variances. We learned 3 of those. We learned the direct labor time, the direct labor rate, and the total direct labor variances. And we also talked about the type of discussion we could have when those variances were of a material amount and were of interest to managers. Here on the screen is a variance summary. We will not be covering the overhead variances on the exam, so I would like you to focus on the 6 variances to the left, those in blue and those in pink. We spent a lot of exercises and problems making sure that you were comfortable with either the author's method of computing variances or the alternative method that I showed you in class. As always, we are here to help you. If you find yourself struggling with anything mentioned either in the book or in the video, please reach out to me during office hours, or we can meet outside of those hours if your schedule mandates. Or we have an awesome embedded tutor on this journey with us. Reach out to him as well. This is Professor Johnson signing out.